Number one rule of Wall Street: nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
And so it goes the first trading week of March. And again, the market has been particularly volatile. So if you survived that, welcome back for another weekly market recap. So we've got a lot of news hitting the economic calendar this week. And of course, as usual, in this period, geopolitics, politics, claims, announcements, speeches. The world is really going 200 miles per hour right now, so it's really hard to keep up. But beside all of that, let's just try to be focused on the market. So let's start out as usual with the economic calendar. And on Monday, we got inflation coming out of the Eurozone, and it was basically in line with expectations. Not huge deviations here as for the previous read, expectations and whatnot. So all cool there. Out of the US, we got ISM manufacturing PMI. They actually ticked up a little bit, maybe. Let me zoom in, I can't see. No, it was lower. It came in lower compared to the previous read, but kind of in line with expectations. 30 basis points, not a lot in terms of the miss, right? So it stays positive. It's not strong, absolutely, but what you might see a bit stronger is the ISM manufacturing prices. So this is what you might say it is a good positive read. Now again, there are a few things you might want to consider before being carried away, okay, with optimism and whatnot. A lot of what we are saying when it comes down to these metrics right here, and for instance, the imports, exports, the balance of trades and whatnot, a lot of that, in my view, is just people trying to front run tariffs. Okay, so there's a little bit of that dynamic in here. We are gonna touch back onto it because it might be important, and it might be even more comprehensive to look at it in a broader context. Together with other economic data points. But just remember that for a minute, okay? Going on, we got ADP non-farm employment change, which that was really negative in my view. I actually got a chart of how the actual headline is decomposed. We might have a look at it later on when we talk about equities. But as for the headline, of course, you can see that it was forecasted 140K. The previous one was 185 more or less, and it came in at 77. So I don't think it's positive. By the way, I don't know. It's just out of curiosity because I didn't know that. I actually figured out this week. ADP is actually a public traded company. If you want to check that out, they also got a stock, which when I checked, it's in a decent uptrend for now. So not bad. I guess they are the company which is responsible to provide the data for the payrolls and whatnot. So that's why they got these kind of authority when it comes down to estimate employment change. Just bear in mind one thing, which is another one that I figured out. They only take care of the private sector. So what you see in here shouldn't include the public sector, just as far as I could gather. Then again, if I'm wrong, please let me know in the comment. All right. So what's next? We got PMI for services this time, and keep maintaining these sort of a I'm going to use a very abused word these days. They are a bit in stagnation. Stagnation. Be careful there, not stagflation. So they're just stuck in this range. They're not really coming down, but they're not really going up for now. So a little bit of a choppiness around these levels right here. Being these a diffusion index, up until the point the value stays above 50, that's still a positive. It just shows you that probably we are seeing a little bit of a slowdown in these particular metrics right here. So at the end of it, the entire US economy, it's kind of slowing down. Maybe like it's not plunging, right? But sure, it's not growing at the same rate it was growing coming off of the pandemic for obvious reasons, right? So is it massively worrying? Is it not? It's just another data point. You pair it up with all the rest, and over time you start to see the trend. That's it. What's next? Oh, well, the ECB actually, that was widely anticipated. They came in and cut rates by 25 basis points. No news there. Although, as we are about to see, the euro actually moved a lot this week. Not the way you might anticipate, though. All right. Then what? Getting back to the US, employment claims came in at 221K. The previous read was what? 242, and it was forecasted at 234. I'm not particularly impressed by these data point in and of itself, but if you want to add a bit of details into it, we might want to check, the 4-week average, and you see it stayed particularly constant. It ticked up by what? Uh, well, just to me, that could be just a rounding error, to be honest. Um, and then what you got is the continuing jobless claims. They, these one, they came in a bit worse than expected because, of course, you see the consensus was this one. So it came above the consensus and above the previous read. So that means, again, more people get into the unemployment claims. They do got the unemployment benefits and they cannot find a new job. Therefore, they stay on the unemployment line and they keep on receiving the benefits. It's still not a very positive sign for the labor market, right? And then on Friday, we got the big one. So we got the unemployment and the NFP. Unemployment was kind of, normal. I guess it was up like what? 10 basis points? Yeah, 4.1%. Still, it looks like the trend, it's starting to be a bit more consistent to the upside, but no major spikes yet. And as for NFP, that was kind of negative in my view. Um, Came in below the forecast. Yeah, it was slightly higher than the previous, but if you start to check the trend, now you see it's not rosy at all. As for the average hourly earnings, eh, coming down, not picking up at least, so not cool. Do I have on these other calendar the what was that? No, still earnings. I was just trying to check if we got hours worked, but it looks like we don't. One thing which caught my eyes was this one, U6 unemployment rate. Therefore, I went and checked. So it looks like it's some sort of uh, an adjusted measure which adds marginally attached workers and workers forced to work part-time for economic reasons. So it's what? A much broader read as for the unemployment. Because if that's the case, it again, it doesn't look good, man. So, I mean, I don't really know. I just wanted to check the definition first. So you see different set of data, and not all of them are actually positive. So again, we might see a deterioration in economic conditions, and therefore now we started to really put some serious thoughts in the R word once again. Although, we've done it in the past, didn't really end up well for the Bears, but who knows? This time might be different. So let's just go ahead and jump into the charts. Let's start out with currencies. And as I said, the first thing in the center of the screen is the euro, which might catch your eyes. And although you've seen the ECB actually cutting rates, and you know that most likely the Fed won't cut, when was it? Well, actually, when will it be? Should be in 10, 11 days, I guess. So if you just run off of the interest rates differential, you should expect the euro to plunge. Instead, the euro had a massive reaction to the upside, same as the pound. Both hit previous resistance, so they both traded back in this previous apex. Considering how sharp the move was, I think we might expect a bit of a pullback here. You would expect at least a reaction, and then we'll see if the trend can actually keep on going to the upside. As for the DXY, you've seen it. You remember last week it was about this might be just a backfill, so it doesn't really change a lot. Although you might say, yeah, but we traded above a previous high. Yeah, but again, I remember actually saying it. Looks like just a backfill, so let's wait it out. At the end of it, there was this previous area of support, which was front run at first pass. So, the other areas of potential supports were this pocket right here and the EQ of the macro range. So we completely shattered the first area of potential bounce, and we got back directly around the EQ of the overall macro range, which is going on for 2 years now. Paradoxically, if you check something like the Canadian dollar, it doesn't really show the same level of appreciation. And again, there might be a narrative or a story there, I think. Although, just let's hint at that 1 second. But just remember, it's not only about currencies. Uh, this is one of those times when you need to look at different assets and different markets and try to put them in the same context, at least the way I see it. Okay, so what we see here is the dollar plunging, okay, the euro ramping up, the pound up, Canadian dollar not so much. Okay, now we still got talks about tariffs, not tariffs, 25%. No, but then you know what? But on those goods which are not included in the previous free trade agreements that we had, oh, then Justin Trudeau just called in and said maybe he wants to make retaliatory tariffs, or maybe he wants to be cooperative with the US. Look, I guess the problem with the Canadian dollar now is uncertainty, right? While instead, the other narrative which might cause this sort of a pump in the euro, especially, and in the UK or the British pound, is it's what's going on in Europe now, about the rearm Europe or reconverting the industrial system, taking out a bunch of debt to fuel the economy and try to spur economic growth, on this wave of, the old alliances are dying down. We are on our own. If we don't do it now, we are facing existential risk. And therefore, again, one might say, yeah, this is good, but there is the counter argument of what happened when Japan did it? What happened when China did it? So again, this is why I say it might be just narrative or knee-jerk reaction, because we don't know if all the measurements that Europe is discussing right now are going to be implemented or not, and especially we don't know when. But again, just a bit more of it when we transition into yields, bonds, and potentially the stock market. For now, just remember DXY down, euro up, British pound up. Just try to memorize these three charts because they're going to be linked to what we might discuss later on. As for the bricks, not going to waste a lot of time. I mean, same stuff. The DXY, although the DXY, again, you should look on the Fred database, they got the actual USD index. The DXY, it's more weighted toward the euro and the yen. But anyway, if you want to use it to grasp dollar strength or weakness, you might say that what happened, let's say, in the Chinese yuan, it's kind of the reflection of the dollar coming back down. Remember the ruble we were talking about, the potential top. So remembering last week levels, we were talking about this shelf. We got back into it, tried to put together a bounce, and then it looks like the bounce was faded on a Friday. So a little bit of a limbo, right? Either we take out these high and the next one, or we keep on eating up the shelf and eventually go for a deeper retracement. We'll see. So not a lot on these type of currencies, on these bricks for now. Let's move into oil. All right. Boy, oh boy, oil. I was again, every time I expect a little bit of a grinding action, whatever I'm talking about, it just shatters. And when I say, well, maybe we might see a sharp move, it takes fucking weeks to materialize. So I'm not a good timer, maybe, but anyway, we took out those lows. Eventually, we immediately bounced back up, filling in the down move. I don't know if this sort of a feel is enough. Considering recent behavior, you might expect a bit deeper feel, draw back into the previous fractal. And at this point, I feel like this is the moment where if you zoom out enough, you see that this area in gray right here, that's a little bit of a floor for oil, or at least it's been like that since basically 2021. So we are starting talking years now. Let's just say if I was particularly bearish before, I might be a bit less now. Fundamentally, I don't really think we got reasons for oil to go to the upside. But at the same time, if you look at the technical side, this is an area you might want to approach with a little bit of caution because you never know. Let's say you're short, it touches into it and it got a massive bounce and takes you out, and you're just giving back a lot of profits. So I would expect reasonable people to start to book in profits if they didn't already. And I think, considering the type of reaction we got in the following 2 days after we swept these lows, they might already done it. Okay. Let's look at what gold did. Nothing surprising, but even gold was pretty easy at the end of it. The framework was getting into the week. Look at Friday's low. It just tapped into support at this shelf. If you see this low holding, you might get a bounce. And a bounce will extend it up until this area. The previous down move originated from here. And it was an area which was thick enough. You can see price stayed in this dealing range for a while. And even when he left it, it tried, it came back, and then it went with a much more decisive move down, very impulsive. And so, the farther it goes, the weaker it gets. 2 days down, 2 days back up to where it was. And then it kept on consolidating around these levels. It was kind of nice to see how it played out, let's say on the hourly time frame, because basically this is the Friday low. And you got the bounce, then the market opened up, you immediately take out a high, you got this previous dealing range to the downside, tapping into support, the market opens, goes up, comes back, I can't really break much below the high which was broken on these massive bounce, and there it goes from there up and up and up, and then it just went into a range. So pretty cool behavior on oil. If you were going off of that assumption that Friday's low should have been protected, and then you see the market opening up like this, failing at going down, finding support here, and then you see it keeps on going to the upside. You might have taken a trade throughout all the week targeting these previous levels that you identified maybe on the daily. So, I mean, gold behaved as expected. Um, so now the point is, do we stay in this range now? Let's say in between again, these line and this line, or do we gradually start to grind back into this apex and eating up all the liquidity which was in here and go for new highs? I said at this point, if this bounce is good and if it is sustained, we might go for new highs. So it's obviously the same. Up until the point we don't crack this level, I'm still more bullish than anything else on gold. Also, again, for the geopolitical risk, the period of uncertainty and whatnot. So the chart and the fundamentals should be kind of good for gold. Again, up until the point you don't get a liquidity event, because at that point I'm expecting gold to sell off as for everything else, especially since we've checked the correlations. I guess it was 2 weeks ago, and when you see gold with a much closer correlation to one relative to the S&P, and when you say Bitcoin being correlated almost 1 to the S&P, so all these assets are going into the same direction altogether. So if you got a liquidity issue, everyone is basically exposed on every single asset toward the same direction. What do you think is going to go? Everything is going to go down because everything might be sold off. Then I guess after that, gold might be the one which catches a bit sooner than all the rest. But in the event of a liquidity issue, I guess all gold would be sold off too. It's always the same insurance policy type of dynamic, right? Let's have a look now at Bitcoin. Oh, Bitcoin. Um, Funny week, isn't it? I just ended up my recording last week, and a few hours later, I watched these going on. The announcement of the strategic reserve, whatever the fuck. Which, look, I know I have the tendency to piss off a lot of Bitcoin maximalists, but I don't mean that. I mean, I'm not trying to piss you off, okay? And I totally get the point of keep on putting money into it because overall, if you look at the long-term trend, this thing only goes up. All right. If you got enough time, if you're trading looking at the monthly chart, for instance, this thing is a clear uptrend. All right. So I'm not saying it's bad. I'm not saying it should go to zero, but I'm just trying to actually to help. Okay. Those guys which are opening up positions with a 25, 50x leverage, holding to those positions they put on just because of the news, and then being completely amazed of why then you got a candle like this and you are immediately taken out. Now you might say, yeah, but I took profit here because it was a previous resistance. Fine, absolutely fine, if you can do it. The problem is that this sort of a slot machine mentality I see, especially in crypto. I'm not saying there's not in other markets, but crypto, it's kind of the king for it. I see people trying to put on these positions and thinking they can hold it for months. Um, Look, I'm not saying it's completely impossible. I'm just saying the odds are completely against you. So what you're gonna do? That that was kind of the talk of the hour throughout Sunday, Monday, and so on and so forth. I mean, look at the candle. On Monday, basically, it almost goes for the lows. So all the people buying into the news, that they are out at this point. Whether they are liquidated or whether they just push it out of the trade, but they are out. Um, and then again, maybe those, and I know a few actually, maybe those which were a bit smarter actually tried to fade the bounce. Again, not saying it was easy to fade. I'm not saying it wasn't something which might get a bit under your skin, like sitting on the ask right here, looking at this thing pumping like crazy and thinking, am I picking pennies in front of a steamroller right here? I get it, but it's very counterintuitive. Oftentimes, you want to be filled on your positions if the market is either plunging into them if you want to go long, or the market is pumping sharply into them if you want to go short. So take it or leave it, I guess. Other than that, we've seen just, I guess yesterday there was the summit at the White House. I've seen Michael Saylor was there. Funny thing I've noticed, no one, none of them had red laser eyes. And I wondered, is this a crypto summit? No laser eyes? Why no laser? Fucking bring the laser eyes. But my stupidity aside, I guess at the end of it, we are still in these kind of a trading range for now. I still think it's particularly weak because that's what you expect after a a pump which is news driven. And overall, if you keep on considering it as a risk on asset, and you look what's going on in the rest of risk on assets, especially those denominated in US dollars, like the equity market in the US, I don't see any reasons to be short-term bullish. Look, again, because I know people always like to call me out on this, but when I say short-term, for me, short-term, it's basically next week. Okay? Don't get back in a month and saying, see, told you. Yeah, okay. Maybe we got different definitions of short-term, right? Considering the majority of my times in market, my positions can last from 2 minutes to 20 minutes. So I'm I'm very conservative when I talk about short term, right? Now, how do you know, or how could you know if this market finally gets its own shit together and start again an uptrend? Well, first of all, you would need to trade above here, right? And much more preferably above here, as I said in last week's video. And again, but if you do that, you miss the low. Who the fuck cares? Because at the end of it, if you're looking at it for the long term, you don't care about the lows. All right. So you just want to buy into something which is showing strength and show potential for a decent uptrend long term. And then when you say long term, you can talk weeks, if not months, right? But trying to catch the knives, yeah, you can do it. Might work out well one time or maybe two, and call me back in 10 years and tell me how it worked out for you, right? So enough of these. Before transitioning into rates, yields, bonds, the equity market, let's take a brief pause. So, I mean, we can just recap all of what we've seen so far. And remember what I told you about the DXY, the euro, and the pound before getting into the rest. All right. I'll be back in 3 seconds, I think, as usual. So checking yields in the US, what do we see? Well, of course, they bounced. All right. And again, not surprising. We were prepared to a bounce. after a sharp move to the downside like this. Okay, there is no surprise here. That was very much expected. And again, conversely, what you've seen on the actual bonds by looking at the ETFs. Oh, look at that. TLT actually hit that resistance we were looking at, and it got a pretty sharp reaction to the downside. So again, it's just a mirror of the other chart as usual. Now, the beyond the bounce in and of itself, we'll see if we can actually go for new highs on the long end and the medium and short end of the curve. I wouldn't expect it. I mean, at this point, you should know it. But again, the market, it doesn't move in a straight line, so it might take time. It is just curious, like to see bonds trying to put together what could be. Let's try to zoom out a bit like this. What could be a complex low right here? Okay, and people keep on talking about inflation, the inflation risk. The Fed is still worried about the inflation risk. Okay, do you remember when we checked, what was it? Trueflation website, right? We were talking about inflation. I guess it was 2 weeks ago when CPI came out, I guess, maybe. But at the time, I think in the inflation as reported by Trueflation, it was slightly below 2%. I think it was 1.94 or something like it. If you check it today, they are reporting 1.37. So again, is inflation a problem? I don't know. Or it might be that what the government is trying to do in the US could actually be a source of some inflationary pressures, but they are dwarfed by all the other sources of potential disinflation, and therefore even the market right now, it's starting to factor in the whole and saying, yeah, well, maybe, well, are we sure? Maybe we should buy back those bonds we sold now, or it might be the right time for it. So that would be one thing. And again, we touched on the Fed Watch tool, saying, well, this tool it's particularly volatile, and although it might price in something right now, it could be in a few weeks it's going to be totally different. And I got those estimates for May, June, September, I don't know, the next few months. So basically the next meeting, which I guess it's going to be March the 19th, I remember I posted the one for May and the one for September, where September was pricing in cuts with a good amount of probability standing to that tool. If you check it now, and if you check not March, although the odds even for March for a cut, for a no cut, actually went down slightly. What really shifted is the forecast for May. I remember when I checked it last week, the odds for no cut were at 85%, and now they dropped at 48%. And the odds for a 25 basis points cut, they were at 15%. They are now at 46, 47. And if you check down the road for June, the market, the futures market, is actually attributing a 14%, 14, yeah. I mean, 13.8. Let's just round it up to 14. 14% chance they do not cut, which is pretty low, I might say. So you see how easy these tools can shift around. They are very much volatile. But I guess the story was never about inflation. Inflation, stagflation, and whatnot. It's funny if you think about it, because do we ever have we ever seen stagflation in the United States? I mean, I was just trying to think of it, and I was like, okay, what's the definition of stagflation? Uh, that should be high inflation, of course, weak economic growth, and high unemployment. I, it doesn't look to me like we got one now. And even all those guys talking about the 70s, yeah, we got higher inflation and we got 2 or 3 recessions, but higher inflation was was matched by a higher growth. So GDP was going up to be completely fair. So we talk stagflation now as it was in the 70s, but was it really stagflation in the 70s? I I don't think it was, and I don't think we are going to see one now. There might be those periods from one week to the next 2 or 3 where you see the data being a little bit conflicted, and you might think that, oh, look, inflation printed a higher number, unemployment went up just 10 basis points. Oh, they revised the GDP estimates down 20, 40, 50 basis points. That's stagflation. See that? Yeah, what if 2 or 3 weeks from that moment, the data is completely different? Uh, if you want to identify a macro regime, I guess it cannot last just a month. It should be something which is sustained, I guess. So a lot of talks, but at the end of it, I don't really think, again, inflation is going to be a problem, stagflation and whatnot. I might think we have a recession risk, which is a bit higher now compared to maybe 3, 4, 6 months ago, but definitely I'm not seeing stagflation. On top of it, and I guess the people went crazy over it, which, to be fair, it's kind of historical as an announcement, but and as what we've seen in market. Have you checked what happened in Germany with the yields on the bonds or on the others, which I don't remember the name, but basically the bonds is the 10-year German Treasury, which in this case the yield for the bonds is the one in blue. Uh, the red, it's the 30 years yield, and the black, it's the 2 years. Okay, they all went up, and they went up because we got this massive announcement coming out of Germany, where after they never did it since basically the reunification of Germany after World War II, they are now talking about changing the constitution and allowing the country basically to take on more debt. They have always been particularly orthodox when it comes down to the debt. And it's no mystery that bonds or German bonds in general have always been seen as very solid in Europe because they are very fiscally responsible. They don't take on a lot of debt. Yeah, sure, they are not offering a lot of yields, but on the other hand, you might be particularly safe parking your money with them. They are very responsible, and now they are facing these. They defined it what in Europe they defined it existential risk. With all this going on in geopolitics, the US may be not being the strong and very close ally it was, maybe even getting out of NATO. Who knows? I'm not saying I think it's gonna get out of NATO, but just to be clear, but just on the rumors, right? We do know markets; they do like knee-jerk reacting to whatever they hear, right? But I think overall there might be two faces to this story right here. This spike in yields, and therefore this big sell-off in German treasuries, it might be very, very good or very, very bad. It depends on what side of the narrative you want to buy into. Let's say it's very bad. Why should it be very bad? Well, because if yield spiked, those underlying assets are going down in price, and although it's not the same magnitude as you might think when it comes down to US treasuries, but all around Europe, people maybe use German bonds as collateral, and therefore, if they drop, we might see what happened in the US with SVB or First Republic Bank on a much smaller scale, which again, for Europe, could be still particularly damaging. And that's one side of the story. Ironically, I don't necessarily think that's the real one, or at least that there are a lot of odds we're going to see something similar to what happened in the US, because whether you believe it or not, the most used collateral in the European banking system, would you guess what it is? Italian bonds. And you might think, but this is crazy. I mean, they got a massive debt, and the European Union, it's always calling them out because of the debt, and they put those balance sheets in order, and yet the banking system is using their treasuries to be the backbone of the banking system in Europe. Well, the problem is that there are way more Italian bonds compared to German bonds. So, although you might not think they are more pristine than the German counterparty, what if you cannot acquire German bonds because there are not enough of them? They don't do that. They don't make that. They don't issue that. So you don't get the treasuries or the bonds. While Italians, oh well, they like to issue debt. And at the end of it, we are still talking one of the G7 countries. I mean, it's unlikely they go bust or they default because, well, I mean, what's going to happen to the EU if the Italian economy and the Italian debt, sovereign debt, is fucked? They cannot allow it because at that point you got no more EU. So the ECB would print whatever it needs in order to save those countries. Well, that country. Well, my country. So again, that's crazy when you think of it. So that would be one side of the story. The other, it might be a story which talks about growth. Whether you like it or not, shifting toward a war economy, it creates a lot of economic activity. You need to build up infrastructures, supply chains, reconverting the industrial system. Therefore, you would probably, I'm not saying for sure, but probably the idea is you might need to employ more people than what you're doing now. Because if your car manufacturing sector is going down, as we've seen with Volkswagen and Mercedes and whatnot, laying off people, you know what? Let's bring those people. Now we need to build up tanks and jets and artillery and bullets. So you still have a job. It's still in the industrial sector. You're just shifting the type of product you are producing. And again, it is good. You still retain your paycheck, therefore you still have spending capabilities. If you can spend, your spending is the income of someone else, and the economic machine just reignites itself. So if, again, big ifs, these are all hypotheticals. If it is a story of growth, well then the market might demand for higher returns in financing the government because the opportunity cost. Why should I lend money to the government when I am expecting the economy to boom so much that basically everything I can touch, it's going to go up in value or it's going to yield me more? If my government wants me to lend him money, they need to pay me more. Otherwise, I'm not going to hold these boons or whatever. So that could be the story about growth. The problem there is, although in a growing economy, you would want to see yields going to the upside. Not massively, not spiking, but slightly grinding to the upside. That would be a normal growth environment. The problem is, or at least the major argument against it, the major objection might be they're doing it with public money. And we've seen what happens when the government is taking the driving seat of the economy. Inefficiency, malinvestment, misallocation of capital. So who's saying that at the end of it, this bazooka, it's not going to end up like it did in Japan, China, and whatnot? That might be the huge risk. So again, I'm not saying one is better than the other or one is much more probable than the other, but I just wanted to offer both sides of the coin. Okay, and just remember that if the German people wants to do that, they need to do it pretty quickly because at the end of March, I guess, the new house, as for the parliament, right, they just got elections last week. Uh, the new parliament will set in, and at that point, given the results of the recent elections, it might be you don't really get a strong and united majority to, and you don't get the numbers to be able to change the constitution and allow the government to spend more. So I think these, I don't remember the name. I guess it's Mertz. Yeah, he's a little bit on the clock right now. And the best way for him to pass these reform legislation, whatnot, it would be to do it while the composition of the House or the Parliament it's still the same as it is. And you might be able to get together a decent majority to pass this bill. So again, we'll see. You see how complicated it might get when finance, economics, and politics needs to get all together and being in alignment. I guess it's very rare, but it can happen, I might say. So we'll see. I guess it's still an historical moment, no matter how you cut it, in my view. So I'll try to follow it and potentially report back what I see or my interpretation of it. All right. Now let's move into equities. All right. As for the US, I mean, so again, currencies. Now we've seen yields both in the US and potentially in Europe, or at least we took the German yields as for the benchmark for the Europe, right? Now let's see what happened to equities and what might be the great story there. So checking equities in the US, I guess again we got another difficult week, and yeah, for now no bounce. So what you're gonna do? it's not it's not that rosy for now. But I don't want to spend time on this chart. To be fair, I think I'll need just two or three of them. So big picture might be if you look at it daily that we are checking the ETFs right now, by the way. So still, SPY it's still trying to hold onto these 200 days moving average, while the Qs actually broke it. They broke it on Thursday. They came back to it on Friday, tried to bounce, and they found resistance at it. So still, these kind of a relative weakness into the Qs relative to SPY. And as for the rest, we see that now these moving averages cross is actually materialized. So I guess, an eventual bounce into this region, it might find particular resistance now. It is true to some degree that we are looking at reads on the oscillators which are particularly extended. So I know last week it wasn't that great of a call, but the fascinating and funny and especially very useful thing about that call, it's what I'm going to show you now. If you remember, the call was, well, we might get a little bit of a bounce Monday, Tuesday, right? And getting back to that chart, it was kind of like this. Let's see if I can. There you go. So as you can read, this was Friday. I'm just taking NQ futures and E-mini for the S&P, but it's kind of the same on the Dow. I just didn't draw the area. But we were looking at these tiny prints on the volume profile. while the market was bouncing off on a Friday, getting into the close. So the point was, if we can see the market opening up on Monday, and I don't necessarily care if it's going to be London, if it's going to be New York, but what I might want to see in order to keep on thinking my bias for the weekly bounce, it's good, is seeing the market getting back into this area, bouncing and going up. But what we got instead is the market actually came in, took out all the low prints or single prints or the void in the volume profile. So imbalance, rebalance, bounce, faded. Secondary bounce, faded. And same for yes. It gets into it, bounces, faded, bounces, faded. And then it cracks it. It gets from the other side, it's like your normal support resistance flip, and it's faded again. And you remember what I said? I said, well, if that happens, so if this is invalidated, and there is a clear enough point of invalidation here, if you're looking to stretch it out throughout all the rest of the week, at that point, my bias would massively shift. And I would completely reverse it and saying, you know what, I'm going to try to go and fade and go short on every intraday rally I might see. I'm going to fade rally at that point. You shift and you switch from buying the dips to sell the rips. What went on for the rest of the week? Oh, look, it bounces. Oh, it collapses. What's next? Oh, sharp bounce, quick collapse. And then what? It grinds to the upside and it dies. Sharp bounce and it's faded. And even here, sharp bounce, faded. It tries to accumulate a little bit. It bounces right here, getting into the New York Open for Friday, and it's faded. And it closes down the week with another bounce, kind of like last week. So again, we'll see. But I just wanted to tell you, it's one thing is having a bias, and it's good if you have one. I'm not against having a bias at all. I think it's good if you can have one. The problem is try to not get hooked on a bias. Because what happens if you spend the rest of the week trying to buy every single bit, every single dip on this market? It's going to be a very difficult week for you, I might say. Because the market at the end of it, every time it rallies, immediately plunges back down. So there is a huge conviction on the side of the sellers. They are selling off all the bounces, which is your bearish behavior at the end of it. So again, just pay attention to it because it might be useful in the future. Another thing might be now everyone. Do you remember we were looking at the yen carry trade and people were starting to say, well, this has the same vibes of the yen carry trade debacle. I might say that there could be one problem with it, and it could be this one. If you remember when the carry trade in the yen kind of blew out, that's the type of price action we got. It was the end of July, the beginning of August, right? So 1, 2, 3, 1, 2, 3. You see how it goes down. The bounce, sorry, the dump. If you check the candles, the majority of them it's just a body with relatively tiny wicks or shadows up until the point you actually form a bottom. So that's your sharp move to the downside, as I was saying for Bitcoin or for others. That's what you want to try to go and buy if you got the guts, because there is a chance of a decent mean reversion. If you transition to how price is moving now while it's going to the downside, after the initial drop, what you see is goes down, comes back up, goes down, comes back up. And almost every time if it kind of draws back into the previous area, into the previous range, into the previous fractal. You can define it whatever you like it. but it's very structured as a down move, which is why I do think you might get a bounce at a point short. The problem is, I would expect not a V shape type of a bounce, if not more of a complex bounce. So the market just consolidating a little bit, maybe trying to go for new lows, failing at new lows, and then maintaining itself stable a bit up until the point finally, if it cannot sustain and going lower, well, you need a much wider bounce. Still in the context of, well, check the moving averages above you, so you know your areas of anticipated resistance. That doesn't mean that overall the bounce is going to be faded as a whole, but at least on first pass, when you reapproach the 200 days, considering the other two faster moving averages are crossing right in that region, you might expect a little bit of a initial um, type of resistance there. Okay, so that would be it. Another call which I made, and I want to call it out because it was massively wrong. We were talking about the sectors, and I was like, maybe I'm not so worried because at the end of it, the dump it's not generalized. And I took the financial as an example, financial sector. Oh God, Monday they swing fails the highs, and then they're just dying down. So again, at this point, even the financial sector took a little bit of a hit. I think the only one staying relatively positive it's healthcare for now, and probably real estate, which it just looks better than the rest. I'm not saying it's completely safe, but if you check the rest, I guess at this point, consumer staples, right? So staples, healthcare, and to some degree real estate, but all the rest now it's not looking that good. Okay, and let's just check, for instance, the sectors, right? For the last 5 days of trading, yeah, you can see healthcare held up, consumer staples relatively better than the rest, real estate minus 1.6%, and all the rest, like technology, financials, energy, discretionary, not so cool. What what's the matter now with stocks? I guess people are starting to talk about the growth scare, and therefore the market is waking up to the reality that maybe economic growth is not going to be that great. And I guess a lot of it has to do with what the Atlanta Fed put out as for the GDP now chart and report. Okay, now I was discussing about it. I guess it was Tuesday, Wednesday. It was an honest debate uh, with a with an Australian friend I got. Um, we didn't really get to a solution, but we exchanged a few opinions on it. So the point for me keeps on being kind of the same. I mean, I get it. The whole thing was revolving around what type of data are they factoring in and what type of formula are they using. And my argument was, look, I know, I mean, you might have a point there. If the data are changing, of course, if then you put in the same data or the new data in the same formula, of course, the final result it's going to be different. But when you look at something like this being so volatile, again, it's kind of like the Fed Watch tool, right? And they are putting in data almost in real time, okay? And so this thing is actually changing every 10 days, 2 weeks. I think it's too volatile to be completely accurate, or at least the way I mean it, it's I wouldn't base investment decisions off of it just because you get these read which are very deviated from usual averages. That what I would think of it. Now, a lot of what impacted this drop in the GDP now, I think has to do with the balance of trades. So you've seen that there was a huge bump in imports, while exports stayed relatively stable, all things considered. If you think about the formula of GDP, when it comes down to imports and exports, they are factoring in the net. So if you import more than what you export, of course, that's going to impact negatively on the GDP number. So I think a lot of it was this. And again, as this is why I was telling you, remember about currencies as for the euro, the pound, and on the other side, the Canadian dollar. Remember about the yields in Germany versus the yields in the US. And now remember, or in this case, notice the trade balance. And again, I think a lot of it, it's front running tariffs. But the the thing might be if everyone is front running tariffs now, they are basically filling up inventories now. That means that they're not gonna buy or import a lot into the future. So if they don't import a lot into the future, that number might be kind of reverting to the mean in a way. The other side of the coin might be, yeah, we are not going to import a lot. And given the fact that other countries might apply retaliatory tariffs on us, the US, we are not going to export a lot. So on net balance, this is not good for GDP. Again, I get it. I'm just saying, since we are talking about estimate for 2025 and we're just 2 months in, and I mean, these are what, January, February data. I would wait at least till the end of March, if not the end of April, to have a much more solid read on this indicator. Okay, uh, sure, there are risks and there are data points which are actually getting weaker and weaker. Like if you think back at the ADP report, that's not cool at all, right? Um, and if you check, for instance, the component of it, you see that paradoxically, a lot of the good numbers as for the employment went in production, construction, manufacturing, and a lot of the negative numbers went into transportation, information, financial, and education. So I wonder, does it have anything to do with what Elon Musk is doing with the Doge, right? Because at the end of it, it looks like, communication, education, isn't it like a lot of public employee type of numbers? So, that could be it. Which, again, if you consider the US economy, which was fueled by government spending, if you remove the government spending, well, the economy, it's going to suffer for real this time around. And it is the opposite of what the narrative seems to be for now, even if it's a knee-jerk reaction. But this is the opposite narrative compared to what you might have seen in Germany, where they think if the government all of a sudden it starts to spend like a drunken sailor, you might have economic growth, at least in the short term. You might get that sugar rush. You see why they are all connected, okay? And furthermore, keep on talking about tariffs. Now it looks like if you check the S&P, if you normalize, I'm always a bit skeptical when they say normalized price action, but again, it's just statistics at the end, so it might be they smooth out the data set a bit. But anyway, it looks like the S&P is just following the same path it was following back in what 2018, 2019 during Trump first term. I'm not a fan of plotting what's happening now and basically copy pasting it on what happened into the past. Although I think price action it's fractal, it's kind of like history. Yeah, it doesn't repeat itself step by step. It rhymes, yeah, but I'm not a huge fan. Although I'm not denying they might have a point. Same dynamics at play might get to similar results. And that might be another point to it. And of course, again, the government spending kind of being dialed down, that could be another one. But I guess, again, getting back to currencies, if you check the relationship in between the performances of the US assets, aka the S&P 500, relative to the rest of the world, and then you check the DXY, you see there is a nice and clear relationship with a good enough correlation there. And what we've seen, just scrolling back a bit, DXY going down, or here, down. The stock market, oh, down as well. So it might be this relationship actually means something, right? So again, that could be another one. Uh, but it's not all negative. Let's put it this way, because if you check the sentiment, for instance, the sentiment right now, if you compare it with, again, the S&P price action, we are reaching into points which historically coincided with at least short-term or local bottoms in markets, which is again why I say, yeah, it's better if you come up with a thesis for your trading week, and you better be good at finding those spots and those areas where that thesis is invalidated, and you need to try to do the opposite. So it's not bad having a thesis or a bias in and of itself up until the point when that bias goes out the window. Otherwise, you're going to do your ass, most likely. And not to mention, we were checking the VIX 2 weeks ago, I guess. So now, if you check something like the VIX, look, the VIX, usually what you see if you just type in VIX, it's the 1 month period. But there is also another one, which is the 3 month. So the volatility for the 3 months ahead. You can think of it as for a normal futures curve. So you look at different expirations and you establish your conditions of backwardation, of contango, and whatnot. Now, if you check the VIX at 1 month and the VIX for 3 months now, it looks like they're set up in a way which historically, again, contributed or was a signal of potential local tops. Local bottoms in the stock market. So that could be another point in the curve of the bulls. And last but not least, we have talked about it throughout all February, so why giving it now? If you check the seasonality, March it's not spectacular, but it's not completely bad. So if the market can hold itself without, not losing it completely over the next 2 weeks, maybe getting into the end of the month, we might get to a point where March is gone, we are getting into April now, and we might see the market resuming what could resemble a little bit of an uptrend. Okay, so again, I'm just trying. As for the German yields case, I'm just trying to offer up both sides of the coin, and at that point, when you got the fundamental side kind of laid down, you can then check the charts and moving on to the technical side and trying to establish theses, levels, invalidations, confirmations, and whatnot. That's basically my process. I'm not saying this should be the process that everyone else should use, but works for me. So just trying to share ideas with the folks here. And with that, again, long video, but I thought there was a lot to be discussed this week. I guess it would have been a bit shorter if I didn't include a Germany study case or hypothetical, but that's it, I guess. So after that, I'm going to wish you a very good weekend and a good Sunday. And as last week, remember, the beginning of the week, it's usually particularly telling, so try to be focused on it and always try to have invalidations and don't get hooked to a bias. All right, Niels out.
Mm-hmm. Mm-hmm.